The Federal Reserve and Jerome Powell just shocked the world. I'm going to reveal what they did and why they did it in 3 simple, fast steps. Step number 1 is not the mysterious Beige book. That's actually step number 2. We're going to get into this in just a moment. But for step number 1, we are going to go right to the Federal Reserve's dot plot. Editor, let's cut to the internet. Many people in the mainstream media are saying the Fed just pivoted.
Right now, it's a Fed pivot party.
The Fed, of course, surprising markets with a pivot.
And I think they're right. At the very least, they went from a very hawkish tone, saying that we're going to keep rates higher for longer. And all of a sudden, they switched to a more dovish tune. Let me show you what I'm referring to. And this is called a dot plot. Now, I'm sure many of you have heard of this, but you don't know exactly what it is. So let's go straight to the Fed's website. We're at federalreserve.gov. And this is the actual dot plot that we're looking at. You can kind of see why it gets that name. But let's look at the footnote. It explains it pretty well. Each shaded circle indicates the value of an individual participant's judgment of the midpoint of the appropriate target range for the Fed funds rate. That's the overnight rate the Fed sets. And if you look at the dot plot, you can see specific time frames. We've got 2023, then obviously this would extend out into the future. 2024, all the way past 2026, what they describe as the longer run. Thanks, Fed, for those technical terms. And you may be asking yourself, okay, who are these people that are giving their opinion at the Federal Reserve? Well, it's the very important PhDs. We call them the Fed governors. So they poll the Fed governors, and I'm not sure how many there are, maybe 12, 13. I guess I could count the dots if I really wanted to get technical. But let's just say right around 12. And these very important PhDs, the Fed governors, they say, where do you think interest rates should be in 2024 or 2025? And each one gives their opinion, and then they go ahead and put that dot on the plot. You can see the actual interest rate on the right-hand side here, and that's what gives us this visual representation of what they're thinking, or what they say they're thinking, what they want you to believe they're thinking. Very important distinction. So now let's go over to CNBC, and we can see what the big brouhaha is and why rates on the 2-year Treasury and the 10-year Treasury plummeted. The 2-year Treasury was down 40 basis points. That is an unprecedented move. And this is why a lot of the commentators in the mainstream media are calling this a Fed pivot. Have they actually come out and dropped rates yet? No, they haven't. But this is basically doing the exact same thing. So the title of this article, Fed Holds Rates Steady, indicates 3 cuts coming in 2024. Why this is a big deal is because the Fed, based on their dot plot, was indicating, kind of signaling to the market, that they were expecting to do 2 rate cuts. Now they're saying 3 rate cuts. So the market sits back, say, whoa, why all of a sudden did the Federal Reserve go from very, very hawkish, higher for longer, and all of a sudden, now they've pivoted, at least with the rhetoric and the dot plot, to where instead of 2 rate cuts, now they're projecting 3. So then the market, I think appropriately, says, well, maybe they don't mean 3. Maybe they're not trying to spook us about how bad the economy is. Maybe they really mean 4, 5, 6, 7, or even more. And if we go back to the article, we can see them describing this. It says, along with the decision to stay on hold, committee members penciled in at least, okay, so it's not 3, at least 3 rate cuts in 2024, assuming quarter percentage point increments. So that would be a minimum of 75 basis points lower than they are right now. But I think it's very, very important there. They're not saying that they're penciling in 3 rate cuts. They're saying they're penciling in at least 3 rate cuts. Again, this is a very important distinction, in my opinion. So then they go on to say that this is far more aggressive than what the officials had previously indicated. And this is why everyone was freaking out. The stock market went to all-time highs, and bond yields plummeted. But it's not just about the dot plot for 2024. Let's go back to it and check it out what they are indicating for 2025, 2026, and the longer run. You can see the trend here. It's straight down to the point where we get to the longer run, and the majority of the Fed governors are thinking that, or signaling that, in their opinion, the appropriate Fed funds rate would be 2.5%. So you got to sit back and ask yourself why. Now, many of you young people that are watching this channel, you may think that the overnight rate, the Fed funds rate at 5.25% is high. So why wouldn't you want to bring it down? But what you're not realizing is if you go back throughout history, go back 100 years, go back even in the 1800s, and you see that the overnight rate or short-term rates at 5% is not high. It's actually a little bit lower than the historic average. So if the economy is doing well, if the labor market's tight, if there's no sign of a recession whatsoever, then why on earth are the Fed governors themselves indicating that rates will be lower in 2024, significantly lower, and then they'll be lower than that in 2025, and over the long run, they're really going to go lower all the way down to 2.5, basically cut in half from where they are today. Step number 2. So we know what the Fed did. They basically pivoted. So now let's try to figure out why they did what they did. And we're going to start by looking at the Fed's mysterious Beige book. And this isn't some sort of conspiracy Da Vinci Code thing. This is actually what the Federal Reserve themselves calls the collection of the data they get at a local level from real businesses. This is a report that's given to those important PhDs of the Fed governors, I believe, once every quarter. So we can look at the last one, kind of peek under the hood, and see what this report says about some things such as maybe unemployment, which would prompt the Fed to do a complete 180, all the way from higher for longer to, oh yeah, by the way, we're going to be dropping rates at a minimum of 3 times going into 2024. Let's start by looking at a chart of the unemployment rate, going all the way back to the late 80s. On the left, we go from 0% up to 15%. Now, what I'd like you to notice, editor, go ahead and throw up the chart, and we can see that just prior to entering a recession, and that's represented by that gray shaded area, we see the unemployment rate start to tick up. And then during that recession, it explodes higher. This happened in 1990, the early 1990s. This happened during the dot-com bust, the GFC, and it really happened during the cerveza sickness, where the unemployment rate spiked over 15%. Now, right about now, your friend and family member Fred is probably watching this and saying, George, what are you talking about? You're just fear-mongering again. You're just cherry-picking data. I mean, we've had plenty of recessions, and I think there's probably a good reason you're only going back to the late 1980s or the recession that we had in 1990. All right, friend and family member Fred. Editor, let's go all the way back to 1950. We could see pretty much every single recession that we have, we go through this exact same cycle where unemployment goes down, 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 then it starts to creep up, and then stuff hits the fan, and then the unemployment rate explodes higher. So now let's go back to this chart, and I want you to focus on this little teeny bit right here at the end, which represents what's happened recently. This, as I've written on the board, is key. What's the unemployment rate doing right now? It's starting to creep up. Now, this in and of itself, if it was an isolated instance, might not be a big deal, but we have to look at it through the lens of everything else that's happening right now. Number one, the yield curve is massively inverted. The 10-year Treasury right now, as we speak, is over 125 basis points under the overnight rate.
set by the Federal Reserve, the Fed funds rate, which is at 5.25%. So right now, as we speak, the 10-year Treasury trading under 4%. This is a massive inversion. And basically, it's like the Treasury market waving this giant red flag announcing that there is a hard landing, an economic tsunami, recession, depression, collapse, crisis, whatever you want to call it, heading straight our direction. And if for whatever reason your friend and family member Fred wants to completely ignore the yield curve, well, let's just look at another index. And appropriately, this is called the leading economic index. And it basically takes several data points, puts them all together, and then displays them on a chart. Editor, go ahead and throw up that chart, please. And we can see that every single time this leading economic index has gotten to the point where it is today, we're not only headed for a recession, but we are actually in a recession. And I'd also like to point out that the Fed's very own interest rate curve, the one that they themselves say is the most important, that is the near-term forward spread, is also massively inverted, just like the 2s and 10s. But getting back to the whiteboard, all of these leading indicators that would suggest we're not headed for a no landing, we're not headed for a soft landing, we might not even be headed for a hard landing, but we are headed for a crash landing. The Federal Reserve obviously can see all this stuff, and that has to go into their decision-making process. But it's not just the leading indicators, I think it's also the lagging indicators. They might be even more important. To explain what I'm talking about, editor, let's cut right to the Fed's mysterious Beige book.
All right, guys, so here it is. The rather secretive, not too many people talk about this. In fact, if you say the Beige book, it does sound like kind of something you hear from Alex Jones. But it's an actual report that comes out 8 times a year. I think before I said it was quarterly. I looked it up. Actually, 8 times a year. So we can see the most recent report was released 2 p.m. Eastern Time, November 29th. So you would assume that this would heavily impact the decision-making and the rhetoric, or maybe the dot plot coming from the Fed in their most recent meeting, where Jerome Powell went from being very hawkish to very dovish. So what is the Beige book specifically? We'll read right from the report. The Beige book is a Federal Reserve System publication about current economic conditions across the 12 Federal Reserve districts. It characterizes regional economic conditions and prospects based on a variety of mostly qualitative information gathered directly from each district's sources. So this is boots on the ground insider intel at its best. So let's go down to the summary, and I want to focus on labor markets specifically. Why? Because every single time that you hear the economy is doing well, the economy is doing well, the economy is doing well, they look at or they cite the labor market. And we know, by looking at the whiteboard, that this is a lagging indicator. So let's see what this boots on the ground intel is telling the Federal Reserve right now about this so-called strong labor market. Demand for labor continues to ease as most districts reported flat to modest increases in overall employment. The majority of districts reported that more applicants were available, and several noted that the retention improved as well. So why would retention improve? Because if the employees themselves look out in the job market, and if they're less confident about their ability to get another job, they're less likely to quit. Therefore, the retention for the employer goes up. Reductions in headcounts through layoffs or attrition were reported, and some employers felt comfortable letting go low performers. And in every single cycle that we see, economic cycle and therefore employment cycle, the low performers are always the first to go. And if you have a business, if you're a small, mid-sized, maybe large business owner, I think that you can attest to this. Over the lifespan of your business, if you've got to tighten the belt, who are the first people to go? the people that are producing the least. Getting back to the report, wage growth remained modest in most districts, as many described easing in wage pressures, and several reported declines in starting wages. Now let's go through and read just the first sentence from some of the districts when they summarize what's happening locally. Boston, economic activity was flat or down. New York, regional economic activity continued to weaken. Philadelphia, business activity continued to decline. St. Louis, activity was slowed. Cleveland, the district's economy contracted. Minneapolis, down slightly. So I'm not going to read all of them, but they're pretty much the exact same thing over and over and over again. So you've got to ask yourself, if you're Jerome Powell and you're getting all of this information, all this negative economic information from the districts, although it may be anecdotal, you're combining this with those leading indicators that we were talking about on the whiteboard, and then you're looking at that chart of unemployment start to tick up, and you've got to assume that the probabilities are very high. The unemployment rate is going to continue to go up and up and up. You've got to ask yourself, if you were in charge of the Federal Reserve, what would you do? Most likely, you'd be pivoting as well.
Step number 3. I think there's another reason why the Fed may have just pivoted. It's the banking crisis of 2024. Now, I know a lot of you right about now are saying, George, oh, no, whoa, time out here. This must be some sort of misunderstanding. You need the editors to fix that. You mean the banking crisis of 2023? No, I mean the banking crisis of 2024, which I think is an extension of the banking crisis that we had in March of 2023 when Silicon Valley Bank, Signature, First Republic, and let's not forget Credit Suisse went bust. Let me show what I'm referring to. Let's go to this chart all the way back to 2014. On the left, we go from $0 billion up to $140 billion. This is the BTFP, the Bank Term Funding Program, also known as the Fed's bailout of the entire banking system in March of 2023. Now, I must admit, this is probably the easiest chart I've ever drawn on the whiteboard, because if you go back to 2014 all the way to 2023, you got nada, nothing. The BTFP didn't exist. But for some reason, the Fed's website, the Fred website, still shows it going all the way back. So anyway, what we want to focus on is what happened in March. Now, if you listen to the mainstream media, CNBC, Bloomberg, or even financial Twitter, I'm sure you would be under the assumption that the Fed solved the banking crisis. They rode in on their white horse. They set up another one of these tools or these programs, and the problem was fixed. So, George, I don't even know what you're worried about here. No, we're not having a banking crisis. No. What are you talking about? The Fed, you got to admit, George, I know you hate the central planners, but this time you're wrong. Jerome Powell and his 900 PhDs came up with a very, very clever solution, and you got to give credit where credit is due. Okay, let's go back to the chart. You got to love me playing devil's advocate. I do it well. I try to do it as well as I possibly can. Okay, so in March, this line went straight up. This was the utilization. This is all the banks going to the Federal Reserve saying, please bail me out, please bail me out. I don't want to be the next Silicon Valley. And the Bank Term Funding Program went straight up, as you can see, to right around $60 billion, a little higher than $60 billion. So again, if you're listening to the mainstream media, you would assume that this would have gone all the way back down to zero, because that banking crisis is old news. It's behind us. But wait a minute. What's going on with the BTFP? Oh, that's right. it's going up even higher, skyrockets a few months later to over 100 billion. Now, I want you to pay very close attention to what it has been doing recently. It hasn't been just going higher, it's been going straight up. It's been going parabolic, if you will. But what's interesting is this is happening at a time not when rates are going up, but when they're actually going down. Why is that important? Let's rewind a little bit and go back to what the BTFP actually does. So all these banks had these treasuries on their balance sheet that they bought when the interest rate was, let's say, 1%, 2%. And as you guys know from watching my videos, there's an inverse relationship between the price of a treasury or the price of a bond and the yield. So if the yield goes up, the price, the value of the bond goes down. So if interest rates on the 10-year, let's say, go from 2% to 5%, and you're holding on to that treasury, you have taken a massive paper loss. Now, if you don't have to sell, it's no big deal. But if we're in a banking crisis and you got to sell some of those assets on your balance sheet, now all of a sudden, you're going to take a huge haircut. And now, because the banking system has even more systemic risk than it did in 2007 and 2008, this becomes a very big problem. So the Fed steps in and says, look, banks, for those of you who are in trouble, you go ahead and give us your treasuries, and even though they're worth a lot less, we'll give you 100 cents on the dollar. So if you paid $1,000 for that treasury, even though now it's worth 500 bucks, we'll still give you that $1,000. So if the banking system was healthy, if it was back to normal, if we've got nothing to worry about, what you would expect is, well, first and foremost, you'd expect the BTFP to be all the way back down to zero. But what you would expect is when rates go down, especially when they plummet, like what we've seen recently on the 10-year treasury, then the BTFP would go down because the value of all of those treasuries that they're holding on their balance sheet are going up. So if the value is going up, why on earth would they have to sell those treasuries to the Federal Reserve to get that liquidity? The answer is because the banking system itself, and I would argue the entire global monetary system, is fundamentally unsound. And because it's unsound, that means the risk, the perceived risk, is increased massively. And if we have an increase in risk, that means banks aren't lending to one another. And therefore, their only option is the BTFP and the Federal Reserve. And one more thing that I'd like to point out, editor, go ahead and throw up a chart of the 10-year treasury, is not only that the yield has gone from, let's say, 5% all the way down to 3.9%, a huge decrease, therefore a massive increase in the actual price of the treasury. But when we go back to March of 2023, we can see that the 10-year kept going up and up and up, and it got to a point where it caused problems for these banks. But that point was higher, that yield where the banks started to crack was higher than the 10-year treasury yield is today as we speak. And in spite of that, the BTFP is not just going up, but it's going straight up at an alarming rate. So what this tells the Federal Reserve is the probabilities are high and increasing that moving into 2024, we'll have another banking crisis. I would argue it's an extension, or it would be an extension, of the banking crisis that started in March of 2023. So if you're the Federal Reserve, you're looking at all this and you're saying, okay, yeah, that no landing, soft landing thing, that's completely off the table. Now we're looking straight into the eyes of a hard landing, if not a crash landing. Therefore, even if we have to risk looking like the next Arthur Burns, we've got to change the narrative and we've got to pivot ASAP. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.